Welcome to the IMFG Quarterly Market Update. My name is Scott Douglas. I'm a director with IMFG, and today here I have with me Dr. Steve Garth, who's going to run through what's been happening in the June 26 quarter and over the 12 months in the markets. So Steve, let's start with Australia. What's been going on here over the last quarter?
Well, it's certainly been an interesting quarter, Scott. Just in sort of context, if you think about it, we've had a war going on in Iran, which has only just kind of ended. Inflation's been up, interest rates are going up or on hold, commodity prices are volatile. You would have thought it's really bad for markets, but in fact, it's not that bad. So when I look at Australia, you can see we've got some modest gains there. In the quarter, a 4% return, that's not too bad. Over the financial year, it's a 6.1% return, so that's a little bit lower than the long-term average. But you can see what's going on there. Every time Australia really gets going, it gets knocked down by something. Either an inflation data comes in and goes down, then it gets going again and something happens, like one of our big companies gets a bad earnings report, it goes down again. So very much a seesaw pattern for Australia, but all in all, not a bad return at 6.1% over the financial year.
Right, okay. And so if we then turn to the global markets, where we're seeing a different picture, what's been going on there?
You are right. We are seeing a different picture when you look at the global markets, and I'll start with this slide. On the left-hand side are the developed markets. It's an index. You can see it's up over 12% for the quarter, so that's a huge quarter, and over 15% for the financial year. Now, the biggest components of the developed market, Scott, are the US, Europe, and Japan. You can see that in the next three columns. Now, for the last couple of years, we've always talked about America leading the way, but you'll notice this quarter and this year, it's actually been very even. Everyone's doing really well. So phenomenal returns, largely driven by tech and AI again. And then the emerging markets on the right-hand side of that chart. Wow, look at that, up over 22% for the quarter and over 35% for the year.
So how do you explain that?
Yeah, great question. So it's still tech related, but instead of sort of the AI companies, these are the semiconductor chip makers in Taiwan and Korea. Would you believe, Scott, the Korean stock market is up 196% over the 12 months. And Taiwan, they're a bit of a laggard. They're only up 100% over the 12 months.
If we then look at what, in the defensive parts of portfolios, the bond market, what have we been seeing there, given that we've had some changes in interest rates?
Australia and the US both got whacked by a rise in bond yields when the war started back at the end of the last quarter, because oil shot up 80%. And to be honest, everyone thought that the world was going to go into a global recession because inflation would be so high. What's happened since that point, certainly in Australia, is inflation readings aren't as bad as expected. So the bond yields have been coming down. Bond yields coming down mean bond prices have gone up. So it's not a bad quarterly return for the Australian bond market. And it's also an indication that we may have hit peak inflation, and the RBA, at least at this data, would be unlikely to raise rates again. They're more likely to keep them on hold for a little bit and then start bringing them down. The US has got a slightly different problem. You can see in the chart that the bond yield throughout the quarter actually kept going up. They've only just come off a little bit in the last week. So that probably implies that the US are going to need at least one or two more rate rises, which will not please the president because he wants rates to be cut. But it looks like that the market are thinking we might have to raise rates a little bit in the US. But Australia, I think from an interest rate perspective, that we're probably going to be on hold and come down. So all in all, not a bad quarter or a bad year for bonds, modest returns, they're no longer misbehaving, and interest rates in this country anyway are probably on a pretty good path.
Thanks, Steve, much appreciated. Well, that's been a great year, and portfolios have done well across all the asset classes. Thank you very much for your support through the course of last year, and we look forward to working with you over the coming years. And until then, we'll see Steve again in the next quarter.